Something big just happened in the silver market, and this time it's official. The Shanghai Futures Exchange just confirmed what many people suspected for a long time. In an official notice dated February 5, 2026, announcement number 37, the exchange said that 6 groups of linked trading accounts were caught breaking the rules. These accounts opened too many silver positions in a single day, far beyond allowed limits. Because of this, the exchange blocked all 6 groups from opening new positions. Hello everyone, welcome to John AG Expert. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe. And now let's get back to the market update. Why does this matter? Because it confirms that the massive silver crash we just saw was not random, it was coordinated. In one single morning session, 674 million ounces of paper silver were dumped onto the Shanghai Futures Exchange. Let that sink in. That amount is almost double the entire world's yearly silver mine supply, dumped in just hours. That doesn't happen by accident. And the exchange reacted immediately. When exchanges step in this fast, it means something broke. This wasn't normal trading. This was stress. Where prices sit right now. As I'm recording this, here's where silver stands. Western spot silver, $74 Shanghai spot silver, $82 Shanghai futures, $99 Shanghai premium, about $8. These gaps are important. They tell us the market is fractured. Paper prices and physical prices are no longer moving together. Now let's walk through the timeline, because this story only makes sense when you connect the dots. The short position that triggered everything. A billionaire investor, Bian Shiming, built the largest net short position in silver ever seen. That position was part of the 674 million ounces dumped in one session. Once the damage was done, the Shanghai Exchange stepped in and said, "Enough." They officially labeled the activity as abnormal trading behavior and locked those accounts out. That means this is no longer speculation or theory. Regulators have now documented it. At the same time this was happening in China, something else was happening in the U.S. Physical silver is leaving COMEX. On the very same day, 3 million ounces of physical silver were pulled out of COMEX vaults. Not paper, real metal. Even more alarming, 100% of futures contracts were settling with physical delivery, not cash. Normally, only 1 to 3% do. Total COMEX silver inventory is now down to around 400 million ounces. This is where the picture starts to get uncomfortable. Then come the margin. Hike's next move. The CME steps in. For the third time in just 10 days, CME raised margin requirements. Gold margins up 11%. Silver margins up 20%. These changes take effect after the market closes on Friday, February 6, 2026. This is already the second margin hike this week alone. Here's the key detail most people miss. Margins are being raised even though prices are falling. That's not normal. CME says this is because silver has been extremely volatile. And yes, volatility is high. The daily trading range in silver is now about $14 per ounce, or nearly 20%. But here's the truth, exchanges never say out loud. They don't raise margins when they feel safe. They raise margins when they feel afraid. If gold were the real problem, gold would be hit harder, but it isn't. Silver is. High margins mean stress. Stress means risk. Risk means too many traders are on the wrong side of the trade. And these margin hikes aren't about protecting small investors. They're about protecting the system. You can raise margins on paper, but you cannot margin call a physical shortage. That's why silver always gets hit first, and that's why it gets hit harder. The market is telling you what it fears, and it's not gold. Now we get to the part that really matters. Not opinions, not charts, math. Yesterday's forced sell-off in silver did reduce futures activity, but not in the way many expected. COMEX silver open interest dropped by about 6,000 contracts, likely tied to tokenized silver products and leveraged paper positions being wiped out. Even after that drop, total open interest still sits around 137,700 contracts. That equals roughly 688.5 million ounces of silver promised on paper. Now compare that to how much silver is actually available. COMEX currently shows only about 103.3 million ounces of registered silver, metal that is ready and approved for delivery. So let's say it plainly. 688 million ounces promised, 103 million ounces available. That gap is the heart of the problem. We're getting very close to a point where either COMEX fails or the short sellers do. March is 3 weeks away, the March 2026. Silver contract is now only 3 weeks from first delivery notice. At this stage, exchanges don't have many options left. Find massive amounts of physical silver fast. Let prices rise sharply so demand cools and metal comes out. Change the rules, cash settlements, force majeure, or emergency actions. That's it. There are no secret doors. And this stress isn't just happening in the U.S. Shanghai vaults are draining fast. Today alone, silver stored in Shanghai Futures Exchange vaults dropped by 15%. They're now left with roughly 350 tons of silver, or about 11.2 million ounces. Read that again. 15% of all available silver gone in one day. These low prices are not helping exchanges. They're hurting them. Cheap paper prices encourage physical buyers to drain vaults even faster, especially when supply is already tight. This is how shortages accelerate. Physical silver is disappearing. Physical silver is now leaving the system at a pace we've never seen before. That's why exchanges are uncomfortable. That's why margins keep rising, and that's why these price drops are dangerous for them, not bullish for bears. When prices fall and inventories fall at the same time, that is not a healthy market. That means real metal is being removed while paper pushes price down. That's a warning sign. The March delivery numbers. Now let's look at the delivery history. In 2025, total COMEX silver deliveries hit 474 million ounces. That's more than double what was delivered in 2024. Every single month in 2025 saw higher deliveries than the year before. This wasn't a fluke. This was a trend. Participants stopped rolling contracts forward. They started demanding real metal. January and February changed everything. January is usually quiet, not this time. In January 2026, COMEX delivered 49.4 million ounces of silver. That's massive for a normally slow month. February 2026 is even worse. In just the first few days, nearly 19 million ounces were delivered, almost equal to the entire month of February last year. Even more shocking, nearly 100% of open interest stood for delivery, far above the normal 5 to 20% range. This is no longer a normal futures market. It's turning into a race for physical metal. What March could demand. Right now, March open interest equals roughly 429 million ounces. If 25% ask for delivery, 100 plus million ounces needed, 50% ask, 214 million ounces, 70% ask, 300 million ounces. Last March was already stressed at 80 million ounces delivered. Since then, registered silver has fallen from 167 million ounces in October 2025 to about 103 million now, a 38% drop in just months. And the drain is speeding up at about 785,000 ounces per day. At this pace, registered silver could fall to around 85 million ounces by the start of March. That's nowhere near enough. Eligible silver isn't coming to the rescue. Yes, there is eligible silver sitting in vaults, but owners aren't converting it. Why would they? At these prices, holders are choosing to wait. They believe silver is worth more, and they're not wrong to think that. Even if March only matches last year's 80 million ounces, there would be almost nothing left for May, which already shows rising open interest. If this continues, May, July, and September could all face the same squeeze. That's when confidence breaks. Why this matters. If exchanges can't deliver metal, they are forced into bad choices. Cash settlements, emergency rule changes, force majeure. Any of these would damage trust in paper pricing. The math simply doesn't work. The paper-silver system is under real strain, and it's showing. Now we zoom out because what's happening in silver isn't isolated, it's part of something much bigger. Over the last 48 hours, we've seen forced selling across nearly every major market, crypto, stocks, metals, all dropping at the same time. That doesn't happen in a healthy market. That happens during system-wide stress. Crypto started the domino effect. The first cracks showed up in crypto. Another $350 billion was wiped out from the crypto market in a single day. From the recent highs, crypto is now down roughly 46%. At the lows, crypto, gold, and silver combined lost about $2.4 trillion in market value. This matters because crypto has become the canary in the coal mine for risk. In the last two major sell-offs, Bitcoin started falling before silver and gold. And that's exactly what happened again. When Bitcoin weakens, leveraged positions across markets start to unwind. That selling doesn't care about fundamentals. It's about survival. Why silver and gold follow Bitcoin. Many large funds now trade metals, crypto, and equities as part of the same risk basket. So when Bitcoin breaks down, margin calls spread. Silver and gold don't fall because their story changed. They fall because positions are being liquidated. That's why the silver-to-gold ratio has been tracking Bitcoin so closely during this sell-off. Until Bitcoin stabilizes and starts building a base, downside pressure in silver and gold can continue, even if physical demand stays strong. Stocks are being dumped. 2. This isn't just crypto and metals. Hedge funds are selling U.S. stocks at the fastest pace since October. We just saw the second straight day of heavy selling, driven mostly by new short positions and forced exits from long trades. Out of 11 market sectors, 5 saw net liquidation, led by technology, industrials, materials. Semiconductors, tech hardware, and communications equipment were hit hardest. This is not rotation. This is risk reduction. Amazon was a wake-up call. Amazon stock dropped 10% after reporting earnings, then fell even more during regular trading hours. By the end of the day, Amazon was down about 15%. When a company that size moves like that, it sends a message. Institutions are not feeling confident. Geopolitics add fuel to the fire. As if financial stress wasn't enough, geopolitical risk is rising fast. The U.S. Embassy has warned U.S. citizens to leave Iran immediately. Nuclear tensions are rising. Uncertainty is spreading. When global risks rise, funds don't carefully rebalance. They sell first and ask questions later. Why the sell-off feels different? Here's the key point. Everything is dropping at the same time. Stocks, crypto, metals. That usually only happens during extreme leverage unwinds, systemic stress, or forced liquidation events. In a free, calm market, assets move independently. This isn't calm. The most important signal? Inventories. Here's where silver tells the truth. During the sell-off, prices are falling. Inventories are also falling. That's not bearish. That means real silver is leaving the system while paper selling forces prices lower. That is the opposite of weak demand. Paper versus physical paper traders push price down. Physical buyers step in and remove supply. That's exactly what's happening right now. This is why experienced silver holders don't stare at candles all day, they watch vault levels. And vaults are draining. Global physical demand is rising. Look around the world. In Singapore, people lined up at United Overseas Bank, the only bank there selling physical gold, even as prices fell. Australia, Thailand, and China all reported similar buying behavior. Physical demand is not collapsing, it's accelerating into weakness. The SLV volume explosion. Now look at paper activity. The largest silver-backed ETF, SLV, saw $41 billion in trading volume in one day. That's more volume than any single stock on the planet. That kind of volume doesn't come from calm investors. It comes from forced liquidations, position flips, panic selling. It's a sign of capitulation in paper markets. Same price, opposite emotion. Here's a powerful comparison. The last time silver traded near 60 FARs, back in mid-December. Momentum indicators were overheated. Sentiment was euphoric. Fear was low. Today, silver is near the same price, but momentum indicators are near oversold. Sentiment is fearful, panic is high, same price. Completely different emotion. That doesn't guarantee a bottom, but it tells you something is out of balance. Caution still matters. This doesn't mean risk is gone. CME keeps raising margins. Bitcoin is still under pressure. Hedge funds are dumping assets. Geopolitical risk is rising. When everything is linked together, more downside is always possible, but the structure underneath has not changed. The tension between paper silver and physical silver is growing, not shrinking. Now we bring everything together, because this is where the story becomes clear. This is not about hype, it's not about price predictions, it's about structure, and the structure is under pressure from every direction. What we know for certain first, the facts. The Shanghai Futures Exchange officially confirmed a coordinated short attack on silver. In announcement number 37, they stated that 6 linked groups of accounts exceeded position limits and engaged in abnormal trading. As a result, they were banned from opening new positions. This confirms that 674 million ounces of paper silver were dumped in a single morning session, not by accident, not by the market, but by coordinated actors. This is no longer speculation. It's documented by the exchange itself. At the same time, physical is disappearing. While paper silver was being dumped, physical silver was being pulled out of vaults. COMEX registered silver, 103 million ounces, open interest exposure, 429 million ounces, March delivery, 3 weeks away. In Shanghai, vaults lost 15% of their silver in one day, dropping to roughly 350 tons. That is not normal behavior. That is what stress looks like. Why margins keep rising, CME has now raised margins 3 times in 10 days. Silver margins up roughly 20%, gold margins up about 11%, despite prices falling. This isn't about investor protection. Exchanges raise margins when they fear default risk, not when markets are healthy. High margins reduce participation. Reduced participation lowers delivery pressure. It's a defensive move. The delivery math still fails. COMEX delivered 474 million ounces of silver in 2025 and more than double 2024. January 2026 delivered nearly 50 million ounces, a month that's usually quiet. February 2026 is already near 19 million ounces in just days. March open interest sits near 429 million ounces. Even a 25% delivery request would require more silver than is currently registered. Registered inventories have already fallen nearly 40% in a few months, and they continue to drop daily. The math doesn't balance. Risk-off explains the price action. The recent sell-off is being driven by system-wide deleveraging. Crypto down nearly 50%, stocks sold at the fastest pace since October. Major tech names collapsing. Rising geopolitical tension. Bitcoin is leading the risk-off move, and silver and gold are being dragged along by forced selling, not weak demand. That's why price is down, while physical demand is rising. The physical market tells a different story. Around the world, buyers are stepping in. Singapore, Australia, Thailand, China, long lines for physical metal vaults draining as prices fall. This is the opposite of a demand collapse. This is accumulation under stress. Paper and physical are at war. Paper markets can push prices down temporarily, but physical markets remove supply permanently. When inventories drain during sell-offs, it exposes the weakness of paper pricing. That's exactly what we're watching unfold. 3 key takeaways. 1. The Shanghai Futures Exchange officially confirmed coordinated manipulation. 6 account groups were banned. This validates that the silver crash was engineered, not organic. 2. Physical silver is vanishing. COMEX registered inventory sits near 103 million ounces against 429 million ounces of exposure. Shanghai vaults lost 15% in one day. Delivery pressure is building fast. 3. The sell-off is part of a broader risk-off event led by Bitcoin and forced liquidation, not a collapse in silver S. Fundamentals. Physical demand is accelerating, not fading. What decides what happens next? Two forces are now pulling against each other: risk-off pressure from margin hikes, crypto weakness, and global fear, physical reality of limited supply and rising delivery demands. If risk-off continues, prices can fall further in the short term. But if physical shortages overwhelm paper suppression, especially into March delivery, the system is forced to react. Which force wins determines what comes next. Final thought: paper can change rules, paper can raise margins, paper can push price, but paper cannot create metal. That's the tension now sitting at the center of the silver market. Understand the risks, understand the structure, know your time frame, think for yourself, don't follow anyone blindly. The cracks are showing.